Good morning, one and all, and welcome to today's video. So today I have just the one pair on watch, and that is dollar yen. So I'm going to break that down for you as always and tell you what I will be looking for from this pair if it shapes up. If it does not, then I will not be looking to place a trade. So the reason I have this pair on watch is because we have evidence of the psychological patterns, psychological structures which we look for. So what do I mean by that? We have what is on my data at least an all-time high. I believe that on some people's data who have more data than I do, this is not an all-time high, but regardless, we have a significant high here. Okay, and we tap into this area. Okay, so this would be an area where I would anticipate the bigger players who caught this move to the upside to be getting out. One of the reasons, if you just look at my top six of my watch list, my top six of my wildcard lists, my additional pairs, one of the reasons this is lower down on the list at the bottom of my top six is because it's typically the case that, as I've mentioned previously, these very, very significant highs like this, the higher time frame highs and the very, very significant highs like this, all-time highs and highs that we haven't tapped into for a long period of time. Typically speaking, we break above them before we move to the downside, before we see these runoffs. So there's always a possibility that we come back up to take out this high to break above it before moving to the downside, which means that this trade, if I'm looking for a trade to the short, to get short on a pair such as this, carries slightly more risk. But regardless, you can see we have tapped into this area. We have that double top, and then we have an aggressive runoff to the downside. And notice that we got to this area. This is what I was talking about in previous videos about the nature of the market. How did we get to this area? Okay, we got to this area correctively. You can see these low momentum candles implying that this move is running out of steam, running out of legs, as it were. Okay, we also have some other things that jump out at me. We have a sharp move down there, followed by a sharp move up, and we have a near miss to that area. Okay, so we near miss to an area, and when that happens, often the near miss causes price to come back down. If and the same is true on the flip side, and take out these lows which we near miss to. Another thing I just noticed just before I went live is that if we just zoom right out, okay, and we measure this. So the market is made up of impulses and corrections, okay? So we see here an impulse correction continuation, okay? And typically speaking, the continuation leg out of an impulse correction continuation tends to be of a similar length to the preceding impulse. So if we measure the initial impulse, so I'm measuring from there to there, and we assume that the continuation leg out, okay, where we started to get the impulsive momentum. So there, because that's when we started to see these mini impulse correction continuations, impulse correction, continuation. That lines up here, implying that this 1, 2, 3 wave move is completed. We also measure it from the break. It only tends to need to be about 90% of the move. So if we measure it from the break of that correction as well, that takes us up to here, and that is approximately 90% of the move, okay, give or take. So that implies that that's a completed move as well. So that's a tick in the box. So if I just zoom back in, as I said, because I've only got one pair on watch today, I can go into a little bit more detail, a little bit more of the thought process, which jumps out at me literally in a matter of seconds when I'm doing this, for myself. But you can see here, impulsive move down, implying if we just even if we just measure the pullback, okay, so we have a pullback which is just over 50% of the range, so that's a healthy pullback for a potential impulse correction continuation. Now there, to take out these lows, okay, and potentially all the way down to here, but I'll touch on it in a second. If I just drill down, you can start to see that we have once again, we have this near miss here to this low, which also increases the likelihood of us moving to the downside. However, what we also have you can see this kind of reversal structure here. Okay, so we have this 1, 2, 3, which taps into this sharp area of liquidity here. So there's always a possibility that this is a reversal structure to push back up and take out this high, which I said that typically speaking we would push above before that move to the downside, and then we would have more of this structure. Okay, especially since the market tends to like to move in a fairly parallel manner, and that would be a kind of parallel structure. And there's one of the reasons. So all I'm doing is stacking the confluences. I'm not trying to be right or wrong. I'm just looking at this objectively based on what I've learned to see. Okay. And if we just drill down a little bit further, you can see one of the reasons that that could be the case, that we end up breaking that high, is because I'm now looking at the sequence. Okay, so if we just drill down to the 1 hour, let's just look at this sequence. How did we move down from that significant high? We, typically speaking, we would move in the form of impulses and corrections, and they wouldn't pull back that sharply, and they wouldn't typically pull back more than about 50% of the preceding move. Okay, so the market, when it's doing this, is building volume, okay, for the next leg. Now, if we just look at, whoops, press the wrong button there. If we just look at how price has been moving, we have a little tight correction here, but then we start to see these scoops back up, these quite sharp scoops back up. Okay, now why is the market doing that? Well, one possible reason, and there's another one here, big pullback. One of the possible reasons is that as people are trying to sell this, other people are placing orders at that significant high, okay, or there's orders still up there dragging price up. So each time that people are selling this, it's scooping back up violently, possibly for that reason. Okay, so this is not the greatest sequence, because even from the start we had a pullback which pulled back. Whoops, let's get that Fibonacci again. We had a pullback which pulled back about 75% of the 70+% of the move to start with. Already, this is a slightly less reliable sequence, and this could be a reversal structure to move to the upside, as I said, to take out that high and then move to the downside. However, what have we done once again? Okay, we've moved up out of this reversal structure. We've moved up out of this in a non-progressive way, certainly at this moment in time, because we have this 1, 2, 3, implying that we could, especially as we have a sharp move up here followed by a sharp move down, implying that there's volume here. And this is one of the psychological patterns that we look for. We see a potential three-touch structure where the second touch breaks above the second touch, but doesn't tap into the area of volume, area of value. And then typically speaking, the third touch will break above the second touch and will tap into the area of value. This is what I call the FOMO leg, when it doesn't quite get there. Some people start trying to sell it, whilst the orders that are still up there and being placed in the area are dragging price up. And then you see, if I just auto scale this, you see this kind of move here where it looks like it's going to commit, and then suddenly it pulls back sharply, and then we get that kind of middle section, okay, before that move to the upside, and then we start to see these impulses and tight corrections. So these tight corrections where price is not building up volume implies that if we were going to break out above here, we would typically see volume being built. So we might see something more voluminous like that to break out to the upside. We're not seeing that. We're seeing tight flags, implying that this is actually just a 1, 2, 3 to tap into the area to push lower. Okay, now whether that then becomes one of the reasons I've got my target here, I shall explain that. But one of the reasons I got my target there is because what this could be is we may see something. So let's say we may tap into the area, push down, get a tight flag, which is what I'll be looking for today. I'll explain that more in a minute. We may get down to this area, near miss to it. Okay, this then becomes a middle section. We then push back down, tap into the area, move to the upside. And then this becomes a 1, 2, 3, which taps into the area to push higher. And then this would just be an impulse correction continuation after that reversal structure. And this here would give price enough volume. Enough volume would have been built for a move to the upside, which and that impulse correction continuation, which breaks to the upside, taps into that high, which it didn't break above last time around, and then we see the move to the downside. That's a possibility. So that is one of the reasons why this will be my target here, for the move that I'm looking for today. And if I just drill down, okay, we have that kind of parallel nature to this potential this structure here. Okay, that's a tick in the box as well. We have nice big scoops between the points. If we got there by the end of the day, we would have fairly equal spacing between the touches. If we just measure these, the impulse correction continuation, that would take us up to just above this area, to just above there. So what I will be looking for from this pair, if I just unhide the forecast and put that dude back in his box, is I'll be looking for a tap into this area. Okay, I've written it down. I've tried to be more specific. I know what I'm looking for in the moment, but for you guys and girls who are perhaps newer to Falcon, if you've just joined the Falcon community, welcome. If you're watching my videos for the first time, it's a pleasure to have you. If you're watching on YouTube, then thanks for tuning in. But for these guys who don't specifically know my entry criteria, if price pushes up to and ideally just above our area of value, so that ray line there, then regardless of how it does so, I'll be waiting for a subsequent impulse back down on the 1 hour chart, followed by a tight 2-touch 15-minute flag. So these are minimum requirements. If we got a 3-touch flag, that would be even better, but minimum, followed by a 2-touch tight 15-minute flag. So that would be a correction on the 15-minute chart. So if we got the impulse down, what I'll be looking for is I would then look for a candle. So I'll be looking for, if we got a red impulsive move down, I'll be looking for one 1 hour candle to close green. So that would imply that the correction has started. And then if that one hour candle closed green, I would drop down to the 15-minute chart and be looking for a 15-minute flag, which is a minimum of 6 to 8 corrective 15-minute candles. And then I'll filter the latter on the 5-minute chart. This is something new which I've been doing. You might be thinking, well, why are you trading on the 5-minute chart? That is something which we call AFT, Advanced Falcon Trader. I do know how to trade that. I've kind of shied away from trading that for now, just because I was trying to master the rest of the strategy. But I've been doing this for long enough now. I do know how to implement that, and I'm not bothered or frightened in the slightest of using the 5-minute chart. I'll filter the latter, so I will filter the 15-minute chart on the latter. So if it's just a correction, I'll filter it on the 5-minute chart, and often that gives us a little bit more clarity as to what is going on within the 15-minute flag. I'll filter it on the 5-minute chart, and be looking to get short with either a risk entry within it if the flag is structured. So if there's structure within the 5-minute flag, I'll be looking to get short on the 5-minute chart. So I'll be looking for a high test candle or a retrace candle on the 5-minute chart, and be looking to get short. So it would be like this within the flag. It would look something like that. Or if the flag is not structured, or I miss the risk entry for whatever reason, I've got a very busy schedule. If I miss the risk entry within the flag, or I don't manage to get one because it's just a consolidation, then I will get short on the break of the flag with what we call a reduced risk entry. Okay, and then what I would do is I would use this Fibonacci tool, and I would lock in. I would measure from there to there, down to there. Let's get it exact. And what I would do is I would trail my stop loss, and I would also set a take profit at the 90% mark. And one of the reasons being is because this is one of the new Falcon management tool, the mechanical management based system. Okay, and that would be the area, as I said, where we may see what we typically see at the 90% rule is when price breaks out of structures such as this. Okay, it has a 90%. If it does so impulsively, it has a 90% chance of getting 90% of the way to the bottom, which takes us to there. Okay, and what we could be seeing, as I said, is that kind of near miss. Okay, and then that ends up being a reversal from there. So rather than try and be greedy, what I would do is I would set that take profit and then that would give us something in the region of about 8.5% profit. And then I would just, if we did keep going, because there's always a chance that we could keep going, what I would anticipate at the start of a structure such as this, particularly one which is visible on the 4 hour chart, so we can see that low on the 4 hour chart, and to some extent on the daily chart, if we did move to the downside, the corrections would likely be quite fairly deep. So if we tapped into there, got that move that I'd be looking for, pushed down to here, this is where I would anticipate after such a big move down, some people taking profit. So we could end up with like sideways price action like that if we were pushing lower. And obviously that would take a while to form. So rather than sit through all that, that could take a couple of days before the move to the downside, and it could also pull back quite steeply. So at the bottom of a structure, price can pull back quite steeply, and then if you were trying to hold all of this, you would have to leave quite a bit of profit on the table. And if you're trading, for example, £1 million account, so we're trying to prepare ourselves for when we're trading very large accounts, do you really want to leave all of that profit on the table, especially given that after price has done this, it could then just blast to the upside anyway, because we don't know what the market's going to do. So you spent 2 days waiting through all of this correction for a move to the downside, only for price to then take you out for break even. That, if you had 80 odd thousand profit uh, running there and you just left it, it's probably not a sustainable way to be trading. Okay, that's going to mess with your emotions. I would imagine it would probably mess with mine, and so that's what I'll be doing. So that is my forecast for dollar yen today. I hope you've taken some value from this, and I will see you again in the next video, which will very likely be tomorrow, providing I have a pair or pairs on watch. And of course, if I do place a trade on this today, if it shapes up, you can see I've got an alert set just below the area of value. If we do tap into that area and price does what I forecasted today, then I will place the entry. And if it doesn't, then I won't. That's as simple as it needs to be. Thanks for watching, folks. I'll see you in the next video. Have a great rest of your day.